It isn't lack of intelligence that destroys returns. It isn't bad information, and it isn't bad luck. Most investors sell at the worst possible moment for a much quieter reason. They confuse emotional pain for real danger. By the end of this video, you won't just understand why people sell at the bottom, you'll understand why you will too, unless you design around it. And once you see that, the market never looks the same again. Most people think investing is about markets, charts, news, macro narratives, predictions. But markets are not the enemy. The human nervous system is. The same brain that helped our ancestors survive predators is catastrophically bad at handling price volatility. Your brain is designed to do one thing under stress: escape pain immediately. Markets, by their very nature, are machines that manufacture psychological discomfort. The market doesn't test intelligence, it tests emotional endurance. In behavioral finance, there is a concept called loss aversion. Losses feel roughly twice as painful as equivalent gains feel good. This means a 20% drop hurts far more than a 20% rise ever satisfied you. So when prices fall, your body reacts before your mind. Stress hormones rise, logic shuts down, and selling feels like relief. Not because it's correct, but because it stops the pain. Most investors don't sell because they're wrong. They sell because they want the pain to stop. Markets move in cycles measured in years. Humans think in weeks and months. This mismatch is fatal. When an investor buys something believing they are long-term, but emotionally expects results within months, the first major drawdown feels like failure. The market didn't break. Your expectations did. If your time horizon is shorter than the cycle, volatility becomes unbearable. The media makes this worse. Media does not inform. It amplifies emotion. At market tops, headlines are optimistic, risk is normalized, and participation feels safe. At market bottoms, language becomes apocalyptic, narratives turn moral, and selling feels responsible. Fear peaks after most of the damage is already done. That is not an accident. The loudest fear always arrives after the biggest opportunity. Most investors unknowingly confuse price with value. They believe that if the price is falling, something must be wrong. But price is not value. Price is emotion expressed numerically. Volatility does not mean deterioration. Very often, it means a transfer of ownership from weak hands to patient ones. Price volatility is not risk to the patient. It is risk to the emotional. Another structural problem is the absence of a plan. Most investors buy without answering three simple questions. How long am I willing to hold this? Under what conditions would I sell? And what would actually invalidate my thesis? When pressure hits and those answers don't exist, the brain fills the vacuum with fear. Selling then feels like taking control, even though it usually destroys long-term outcomes. In markets, the absence of a plan guarantees panic. Humans are social creatures, and markets exploit this relentlessly. When everyone around you is panicking, selling feels rational and holding feels reckless. Independence feels dangerous. The herd doesn't run because it's right. It runs because being alone feels unsafe. The crowd feels safest precisely when it is most wrong. Confidence itself is inverted by markets. Near market highs, investors feel smart, risk feels invisible, and conviction feels effortless. Near market lows, investors feel foolish. Doubt replaces conviction, and shame enters decision making. Ironically, confidence peaks when risk is highest and disappears when opportunity is greatest. Markets invert confidence and opportunity. Leverage accelerates all of this. Debt removes time, margin removes patience, urgency removes wisdom. If you must sell, you will sell, regardless of value. Leverage doesn't just magnify losses, it destroys optionality. Bitcoin exposes these psychological weaknesses with brutal honesty. Its volatility punishes short time horizons, reveals weak conviction, and rewards patience asymmetrically. Bitcoin doesn't force panic, it reveals it. Those who survive don't do so by predicting better. They do so by structuring themselves differently. Bitcoin doesn't test belief, it tests time preference. Now, the most important part: What actually works? Not platitudes, not slogans, and not just hold. Real tools. First, pre-commitment rules. Decide before volatility how long you are willing to hold, what size you are allocating, and what would genuinely invalidate your thesis. Write it down. Reread it when emotion rises. Second, position sizing below your pain threshold. If a 30 to 50% drawdown causes panic, your position is too large. Volatility tolerance is not moral. It is physiological. It isn't lack of intelligence that destroys returns. It isn't bad information, and it isn't bad luck. Most investors sell at the worst possible moment for a much quieter reason. Third, separate price from decision. Never make decisions on red days. Delay decisions by at least 72 hours. Emotion decays faster than price. Fourth, anchor to fundamentals, not headlines. Ask only one question. Has the underlying reason I bought changed? If not, noise is irrelevant. Fifth, reduce how often you check prices. The more you look, the more you feel. The more you feel, the worse you decide. And finally, accept volatility as the price of sovereignty. Returns are payment for enduring discomfort. There is no reward without emotional cost. Most investors don't fail because they lack knowledge. They fail because they didn't design themselves for stress. The market doesn't punish ignorance. It punishes impatience. Once you understand that, the goal stops being prediction. It becomes endurance. And endurance quietly and patiently wins.